Hi, I'm Karim Raffa. You've probably seen me hosting, but today I'm going to explain a few more complicated economic concepts. Let's talk about valuation. The valuation of a company is the process of evaluating how much a company will be worth in the long term. As an investor, before you give a company any money, you want to know how much it'll be worth in 10 years from now, but also how much you should invest and what you're going to expect to get in return from your investment. Now, like most things in economics and finance, it's both an art and a science to evaluate the future value of a company. Now, the science part are that there are formal models that you can use. The art is choosing the right inputs and which model is best for the case you're trying to solve. Some of the most famous models would be 1. The market cap model, where you take the number of shares outstanding and multiply it by the share value. That will give you the current value of your company. Number 2 is a discounted cash flow model. You estimate the cash flow of a company over a certain period of time and you discount it to the current present value. Number 3 is a liquidation value. So how much would your company be worth if it went bankrupt today and you had to sell your assets? As an investor on a stock-listed company, be it on the FTSE, the Nasdaq, or the DAX, for example, the measure of valuation is great for a company's potential value. However, because it's such a big exchange and it trades every few seconds, it's very much an investor's opinion of a stock that will make it move. So a listed company with very strong financials but going through a media or PR crisis might see its stock value reduced or decimated even, when the real effect of that crisis has nothing to do with these companies' financials. So as an example of a media crisis, you can think something as extreme as oil spills, to missed earnings reports, to scandalous CEOs, which might have a completely exaggerated reaction on the stock market, but in reality it doesn't really affect the company's balance sheet as much as you'd think. So where does this bring us? Investments in private investments or in startups is very much reliant on two of the models that we looked at earlier: future cash flow assessment and liquidation value, mostly because these are riskier investments. Things become very interesting for two reasons. One, they're very subjective to the investor. So if it's one investor that wants to invest in this company because it's got a certain value to him, that's a totally valid point to that person. It may not be to another. Number two, traditionally, the valuation of a startup after its first investment round reverts to the market cap valuation model. Now, the bigger and the more respected the initial investor is, the more due diligence is assumed this investor did on that specific investment. The more resources you think it dedicated to carrying out that due diligence. Now, if you want to list on a public exchange, for example, that exchange has the obligation to investigate your company and make sure that your company is worth investing in and safe to investors. Over the last few years, there have been several methods made available for companies to list their companies without having to necessarily declare all of their information. You're looking at ICOs, where all you needed was a white paper and a website and people could pay you in a coin in exchange for equity. And finally, you're actually looking at startups as well. Depending on which country you're in, you have to be an accredited investor or not. But in the end, you're really just trusting the information that startup is giving you. In recent years, things have gotten a bit gray when it comes to issuing equity. So when SoftBank backs WeWork with $7.5 billion, its market capitalization goes up to $45 billion. Now that first investment determines the value of a company for future rounds. So earnings and forecasted cash flow may not be connected to the actual valuation or to that investment even. Often it's only when other investors come in, almost retrospectively poking holes into the model, that the real value of the company emerges and the market corrects its value. Now, as we've just discussed, valuation can be discredited, and there must be a different way to value a company for an early stage investment. Now, Alex Wilhelm from TechCrunch recently coined the term 100 million ARR club, which is the $100 million in annual recurring revenue club. This is supposed to be an alternative method to the unicorn valuation club. So if a company can produce $100 million every year recurring, that should be a proof of a solid investment for an early stage investor. The only issue I see with this is that any investor looking for companies that will be worth $100 million ARR in the future will want to get in there early, invest in them early, and thus increase its valuation before it has any proven cash flow, and we're right back to where we started. Now, this perpetuates the hype cycle. And the only real solution to this is for investors to carry out their own due diligence, be it in early stage, very early stage, or even later stage companies. So how do we break out of this hype cycle? Well, first of all, the market is actually correcting itself. After failures of very big investments, VCs and investors carrying out their own due diligence to be certain before they carry out any of their own investments. Now, from the investor down to the startup, it's actually trickled down, and startups that are looking for investment have prepared more accurate and detailed cash flow forecasts to pitch investors and make sure that their investment is secure.